E-commerce companies Amazon, Shopify, and eBay have been benefiting from the increasing convenience of shopping online. More and more consumer spending is shifting online versus shopping in person, and that trend is never going to reverse. It can never be more convenient to shop in person versus shopping online. There's just too much physical space that's required to bring in items to brick and mortar locations, and for a consumer to look and browse around all of those products, compare, it's just too difficult. It's never going to reverse. And so investors are rightfully looking at some of these e-commerce companies and thinking, maybe they might make a really good investment because this tailwind is going to persist for decades more. If you're thinking about these three e-commerce stocks, I'm going to compare them and answer which one I think is the better one to buy, looking at revenue, profit margins, cash flow, and valuation to make that distinction. Let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So looking at revenue growth over the last 5 years, you'll see Shopify is leading the three of them with revenue growth of 26% in the most recent quarter. But for the last 5 years, they've delivered better revenue growth than the other two, Amazon and eBay, even though for moments they've had better revenue growth. But for the longer term, Shopify delivers better revenue growth. And I suspect that will be the case for the next several years. Shopify is growing much faster, offering newer services to merchants who are switching to going online or enabling them to go online versus only brick and mortar operations. eBay has been losing market share for a long time now as its app has become dated and the company hasn't really put in the kind of investment to improve the app. But that's one of the selling points of eBay as an investment. The company puts limited resources back into the business and they allow the bulk of the cash flow that the business generates, they return it to investors rather than putting it back into the business. Now, they lose market share with that strategy, but it generates great cash flow, which is an interesting strategy for eBay. Amazon has been doing a great job with the e-commerce business, but Amazon is more than just e-commerce. Their cloud services segment, in fact, is the most lucrative part of the business overall, and that's where its AI investments are bearing fruit. So with Amazon, you get that robust e-commerce business along with a very robust advertising business and the artificial intelligence business. Comparing these three on cash flow from operations to sales, we get a surprisingly close match. They're all around 18% here, but eBay, you can see it's trending downward in recent years. Its cash flow from operations to sales have been trending downward, while Amazon and Shopify have been improving in this metric. And I suspect this trend will continue because eBay is losing market share, Shopify is gaining market share, Amazon not really winning or losing market share, but it is maintaining the e-commerce business. And since the business is so large, the year over year growth results in billions of dollars of added revenue, which leads to billions of dollars of more cash flow. Comparing the three on a critical metric, which is the return on invested capital, you'll notice that Amazon delivers the best in this metric at 18% compared to 14 for Shopify and 15 for eBay. Given that Amazon's trends are improving and the profitability is improving, I suspect Amazon's returns on invested capital will continue improving, while Shopify is likely also to continue improving. eBay remains a question mark. eBay remains a question mark in that can they maintain their business enough? Can they maintain that niche category enough to sustain their business model? Right? There's categories that eBay can beat Amazon and Shopify on. For instance, resale luxury goods. That's a category eBay can win against Amazon and Shopify. Or purchases and sales of sports memorabilia, another category that eBay can beat Amazon and Shopify on based on its competitive advantages and its core capabilities. But if it tries to compete too broadly against Shopify and Amazon, that might be money wasted. So it'll be interesting to see how eBay positions itself against these larger, more well suited businesses in Amazon and Shopify. And lastly, I'm going to compare them on valuation. And I want you to understand why I'm choosing the forward price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. All right, so now that you've got an understanding of the forward PE ratio, let's look at the three. Shopify, by far the most expensive according to this metric at 78. Then you have Amazon in the middle at 37. And finally, eBay at 12, which is the cheapest of the three, selling at a fraction of the valuation of the others. Now, for me, this is a tough decision because of how cheap eBay stock is compared to Amazon. It's trading at one third the valuation. I don't think Shopify is in the top three. I'm sorry, I don't think Shopify is in the top two. So I can eliminate Shopify right off the bat, put it in third place. Then it becomes between Amazon and eBay. And I do think that Amazon has earned this premium against eBay. It's close now because that premium is 3x. It's closer to the largest this premium has been against eBay. But eBay's business is really falling behind the other e-commerce players. And I'm not sure if it can keep up here. I think it's going to have a challenging time keeping up here against Amazon. And so if I was to pick between these three, I would pick Amazon would be my first choice. I think eBay would be my second choice, and Shopify would be my third. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.